Hey everybody, thanks so much for joining us today. We are so excited. Can you believe there are only 3 more months left in the year? Wow. If you are still working on nailing all of your 2021 goals, be sure to contact us at the end of the webinar. Reach out to one of our fully licensed loan officers. We are dedicated to your success and we're here to help you out. So we will go ahead and get started because we have a very exciting presentation today. We are rocking and rolling, and this is jam-packed with pertinent information to keep you up to date. Before we go into any more details, we do want to just do our normal disclaimer, letting you know that we want to provide this information to help and guide you, but before you go into any deal yourself, to conduct your own due diligence. Our team and our guest speakers today are not liable for any investment opportunities that you partake in based on the information that you receive today. And without further ado, I'd love to introduce you to one of our featured speakers. This is AC Ramos. He is the president and CEO of Cityscape Homebuyers and Prosperity Real Estate Group. They have an amazing networking opportunity each month, and we'll be there on October 14th, so next month, second Thursday, right, AC?
Yes, definitely. Second Thursday every month.
All right. Well, Wade, I believe that you wanted to share a little bit about your experience in working with Prosperity Group as well.
Yeah, we've worked with AC for a long time, and we talk with a lot of his mentees, the people that he mentors, and he does a great job. And the thing that he does that some others don't, I think at a higher level, is just the breadth of things that he teaches people. You know, there's some people that are really focused on one minor category of the business. They might be really focused on flipping houses, or maybe wholesaling, or maybe adding rentals, or maybe it's multifamily. Whereas AC has experience and is an active investor in all these different categories. His team is really good in all these different categories, and they help their people have a very broad range of skills to take advantage of the opportunities that are out there. And the other thing I'll say is that I think he's also just a damn good investor, so you can learn a lot from him, and the people that attend his events are good investors, so it's a great networking event to meet other people that are like-minded, successful, and looking to find ways to succeed in real estate. And most of them, in my opinion, have been very willing to have long conversations and to impart information. And it seems like the culture you built at your event is that it's an event where people want to share and help others. So that's a really cool thing.
Oh, thank you. I appreciate that. Yeah, no, we do pride ourselves on preaching to give back, and we love that. So I thank you. I appreciate all those words.
Coming up,
and they run the gamut between, you'll have people that have got hundreds of deals and then like brand new wholesalers. So no matter where you are in your career, show up to the event and you'll have somebody like-minded to talk to for sure.
Awesome. Thank you. Thank you. Yes, definitely.
AC, you mentioned that you're planning on having another more formal mentorship event coming up. Do you have any more information on that?
We don't have any dates set right now. I'm trying to put together a team, but we have about 37 or 47 properties under management now, with our multifamily and single family purchasing side of the company. So we're going to be doing a buy and hold training. So it'll probably be a 2-day event with in-class one day and bus tour on the second day. We don't have any dates for that yet, but I'm trying to put together a team for that because we are in the process of rehabbing like 16 of those units right now.
Oh, that sounds exciting. If we can work out the schedule, we'd love to be a part of that, and it sounds like a fun event.
Awesome, thanks. It'll be a lot of fun.
Well, we'll keep moving along. Thank you, AC. We're so excited. And guys, we will have AC's contact information on the last slide, so hang tight. And if for any reason you have to drop off, give us a call. We'll be sure to put you in touch, okay? And we also have our, if you're joining us from Prosperity Group and you're not familiar with us, let me introduce our featured speakers today. We have Wade Comeaux, our founder and CEO. He is also an active investor himself and a licensed real estate agent. He's been in the business for over 20 years, and we were kind of cracking some jokes about that earlier because 1995. So we're getting closer to the 3-decade mark, right?
Regrettably so.
Slow down.
All right, guys. I may not be here for the next webinar. No.
Decade. That's all it
and we also have our director of lending, Jeff Johnson. Jeff Johnson also has over 2 decades of experience, and he is active with a lot of our deals. He is overseeing everything that has to do with our lending sector. So if you're ever working with us, you may end up working with Jeff as well. So without further ado, we will move on. And Wade, I'll let you talk a little bit more about us.
But before I'm sorry, Wade, before you get into that, I think we buried the lead on AC's bio. I think we saw at the very bottom down there, 6 children. Is that correct, AC?
Yes, we have 5 boys and 1. We just had our first daughter.
Wow. Well, congratulations.
Thank you.
That's a busy life right there, my friend.
I will tell you, the one girl is completely different than all of the boys. Like, girls are different than boys, and I will tell you it's from birth. It's not a learned thing, it's a born thing.
I would agree with that. I see that your kids participate in soccer. I did not realize you were trying to make your own soccer team, but I applaud the effort. That's
Oh, you should see, like, on Tuesdays and Thursdays. So, like, there's 4 of them are in jiu-jitsu and soccer.
Wow.
So we are running from class to class, like 2 or 3 nights a week, and weekends are turns all day long.
Oh,
wow.
Man, like a lot of fun.
Yeah, it's crazy.
All right, so moving on to the Catalyst value proposition. One of the biggest things we pride on are these first 2 bullet points. One, we want to be a one-stop shop for real estate investors, and that means that whether you want to flip properties, whether you want to buy and hold properties, we really have the broadest array of products that is out there, and we're pretty excited. We've added several new products, which we'll talk about in a moment, but if you want to get into real estate, you're going to talk with a subject matter expert. We have a single point of contact model, a trusted advisor that with basically one credit pull for all of our products can help guide you to the products that work best for you. Not necessarily if you work with another company that has more limited products, they try to tell you why their products are good. They try to tell you this will work. I know it may not be perfect, but this can work. And we just try to give you the broadest range so that if you have a particular strategy, you have a particular credit situation, cash situation, we're going to put you into the best possible product for you. In addition to that, we're real estate investors as well. And we built a lending organization based on that. And we've made mistakes over the year. We have faced challenges. We try to take all that experience and help you maximize returns and avoid some of those mistakes that we've made over time. We have 5-star average reviews on all of our different social media websites and Google. And we take a lot of pride in trying to make sure that the customer has a very good experience and that they want to invest again with our team and that they feel like it's a worthwhile to spend their time to invest. We think we do a very good job of helping them succeed. Again, covering, we got hard money, conventional and non-conventional loans. So a non-conventional loan would be like a 30-year fixed, no income doc loan. And that's a really cool product because you do not have to have documentable income in order to invest in real estate. That's a very big thing. If you're self-employed and you write off a lot of things, or if you're a full-time investor, that does not preclude you from being a buy and hold investor. And with pricing that is the tightest between conforming loans and non-conforming loans that we have ever seen. The non-conforming pricing is outstanding right now and really helps you get very strong cash flows. One big thing we're doing for a lot of people, and AC, if you have any people who are getting a little tight on cash out of your mentees, we're doing a tremendous amount of cash out refis either on their rental portfolio or on their owner occupied homes, right? The home that they live in. And this is really fueling their investments, right? So we, a lot of people think, well, I just bought my house 3 years ago. I think we're going to cover a slide in a little bit. Certain parts of the country, that might mean you might have nearly 40% equity in your home. And how much things have gone up over the last couple of years, right? Somewhere in the 30s, very common, maybe 40% if you're in the right neighborhood. Some of them even more than that. So if you've owned your home for a few years or you refied a few years ago, that does not mean you did not have equity. You can take that equity instead of letting it be dead equity and put it into new properties. For buy and hold investors, we do have rates as low as 6.99% to start. We also have a VIP flip program, rates as low as 9.99% and options as low as 1 point on the VIP flip program. And then these non-QM loans that we're talking about earlier, we also have blanket loans. So we actually did a transaction the other day. I think it included 69 properties. The person was able to get about $1 million cash out to do other transactions. This is a little bit lower LTV transaction, but the rate ended up being 4%, one easy monthly payment. and very favorable release provisions if they ever needed to take one of those properties out. They need to pay it off or sell it to someone else. So very exciting options out there for people who own multiple properties. And then the last thing I want to talk about is Airbnb and VRBO. That is a very hot market right now. Lots of people are crushing the returns that you get from long-term rentals with the short-term rentals. And if you're a wholesaler, it can take a deal that maybe you get under contract at 350 that, you know, it's a little bit tight. Maybe it doesn't work for a flipper, but it will work very well for a VRBO or B&B type investor. And we can provide the hard money to the investor for that, as well as the long-term financing. So what makes this VRBO financing unique is that normally these non-QM products, the non-conventional loans, require you to document that the property itself cash flows. So you have to do one or the other. Either you can afford to make the payments, or the property can afford to make the payments. This particular product has neither of those requirements. It's really just built on your FICO score. So, and the rates can get as low as 4.25 for the Airbnb. So very attractive product. People should definitely give us a call to check that out.
That's a good one. I was just about to ask y'all if y'all did blanket loans, so that's good. Nice.
Yes, very cool blanket loan program.
Yeah, since we launched it, it's been very popular. It was pretty quick. It just took off. It kind of seemed like, okay, we're gonna do this now, and it was rocking and rolling. So I guess it was definitely needed. Before we move forward, I just want to say welcome. I've seen a couple more people join on, and I want to let you guys know if you have questions during the webinar, we will spend the last 10 minutes going over those questions and answering them live. So be sure to use the question box. I'll go ahead and write something in there in just a minute. And without further ado, it is time to get into the meat of the presentation, the market update.
So I'll go back a little bit on that previous slide. I just wanted to say one thing. There's a slide in the future that talks about the amount of, if you bought a property 5 years ago, roughly what the return on that property is. And so if you look about, I don't know, 5 or 6 down, talking about doing cash outs, even if you don't know or you're not sure if you even have any equity, pick up the phone and call a loan officer, and they can take a look at it for you. You know, this is something we do every day. You know, if you're an engineer or whatever you do, this is not your full-time job. So the loan officers and real estate office here, like that's what we do, is we analyze real estate and we analyze deals. So if you want to get into real estate investing and you want more cash, even if you don't think you have equity, just give us a call. We can tell you right away, yep, you know, you don't, but odds are you probably do, because the values have gone, and if you're not into this world, you're really not going to know, but like the values have gone up so much over the last 5 years, specifically the last year. So there is a lot of equity out there that might be able to, you know, get you investing, and you can tap in. Okay, so this slide right here, housing starts, and this is kind of what we've been talking about it for a while, and every time I read articles about the state of affairs, new builds and housing is something they always talk about. If you look at the, this chart is basically a list of new privately owned housing units started, right? So how many houses are being built? If you look between 2010 and 2020, if you notice, there's at the bottom of that chart specifically is the volume. There's hardly any houses being built in the last 10 years. Actually, I think it's the fewest homes built in any decade since the 50s. And that, coupled with the demand for real estate now, kind of tells you why we're in the situation we're in, where prices are going through the roof. It's just simple supply and demand. There is not enough supply, and there is a lot of demand for single family real estate. They haven't been building over the last 10 years. So that is why you see these giant price, or one of the reasons why you see these giant price spikes. Now, on one of the later slides, you'll see the activity is really picking up, especially in Houston and Texas. The number of new builds, Houston is the #1 city in the country. Like there's nowhere else are they building more single family units than Houston. And I don't think Dallas might be second. They're not too far behind either. So people are playing catch up, but until they play catch up and those things start hitting the market, you're going to see these price pressures remain, in my opinion. I don't know if AC, if you've seen the same thing, just a
No, I was about to
limited
say,
supply.
because I mean, for one, especially, I think the numbers are going up in Houston, well, in Texas in general, but especially in Houston, especially after the pandemic, which isn't something I would have likely expected. I would have expected things to stabilize or stay stale for a while. But I think with everybody having their eyes opened up to our Houston market, and then coming down here, I know I've personally picked up investors who are working with me that came from New York and California who literally they told me when they were here, they were like, man, I thought everybody had cows and horses and wore boots. And when I got down here, man, y'all have sophisticated business. Y'all have major highways. Y'all have infrastructure. You have restaurants. You have you know, good looking people, men, women. But that's true though, because you know they think we're all cowboys. They think we're all cowgirls. They think we're all, you know, they and I'm not saying that
Apparently.
funny way. I had a young girl that was working for me come from California. When she went to a closing in the Galleria with me, she was like, where are the horses? Like, you know what I mean? And I was like, no, we don't have, I've never even ridden a horse. I would kill it. But, you know, we don't all have horses. We don't all have cows. But she literally believed that. And she was 20 something years old, 25 years old. And these guys that I met recently who were investing with me and doing some new construction, they're like 30, 32, 33 years old. So they're not young people. That's just the image that us as Texans have had to people. So with that being said, everybody's eyes are being opened up to our market, to our market of everything, you know, our housing market, which includes our industries, which we're not reliant on gasoline anymore or oil like we were in the 80s. We have so much diversity in business. And that attracts people too. So we have many different industries. We have good growth of jobs still, whereas other people don't. We had a super low cost of living. Now that is starting to creep up. Like I think we went up 100,000 in a year. Our median price range, our house prices went up 100,000 a year, and I don't think that's going to slow down. Well, God forbid, hopefully everything else straightens out. But with the housing market, as far as if you look at California, you look at everywhere else in the country, and I tell you, you could buy a house here for 500,000, but it would be worth $1 million or $1.5 million in New York or California or something like that. I mean, now I'm exaggerating the numbers, but would you, if you had the money, would you buy it? Would you invest in it? Of course. So that's going to drive our prices up. So I think we're going to plateau in about 2 or 3 years, somewhere around 3/4 of the prices of New York and California, somewhere in that, around 500, 550. I mean, I'm hoping we don't, because I really don't want to pay that much, but I'm thinking we will. I mean, I just don't see how we can't, because we have a value that's been undervalued for so long. If that makes sense. Do y'all agree? Or I mean, y'all are the experts.
Totally agree. I think we're going to look at a slide towards the end, which is called basically the affordability index. And you're right. You look at the numbers, you know, Houston, Dallas, Austin, San Antonio, those are major cities with a lot of the amenities that people who want to live in big cities expect: job opportunities, access to culture, entertainment, different things like that. And the price points for these major cities in Texas is just extremely low. Then in these other places, they also have higher taxes. They have state taxes, which are higher. They have a less business-friendly environment in many ways, right? The lockdowns were longer, or just in general, it's more difficult to open a business and sustain a business. Very pro-business in Texas. So there's many different reasons that people are wanting to come down here. But you just see the numbers, and they're undeniable. The migration from those areas to here is going to continue. And to your point, it's not always going to be as cheap as it was, but there is a long way to go before it's as expensive as it is in those other places. A long way to go. So I think there's a lot of room to continue to go up.
Oh no, we still have room. We still have opportunity. I think now is definitely the time to get in.
No doubt. Next slide. So, I have been fortunate enough to go to probably 3 different industry events in the past few months, and a common thread is exactly what is talked about in this article, Wall Street Journal. And it is that mortgage trusts, pension funds, hedge funds, private equity, investment banks, all these groups want to get involved in short and long-term investments and in loans in single family. I can't tell you how many times I heard from some of the biggest hedge funds in the country that their most desired asset is single family homes. Like, they really are excited about that particular category. And that's why we see some of these non-conforming products that are not backed by the federal government through Fannie, Freddie, FHFA. They're not VA loans, they're not FHA loans, they're not any of those things. These are just Wall Street backed products. And they really want to either be in the loan space for single family, or they want to be in the actually flipping homes or owning rentals themselves. They're doing it in a wide variety of ways. They're really pushing to acquire properties. They're pushing to do build to rent. You may have heard this neighborhood north of Houston. I think it was a DR Horton neighborhood where they ended up renting out the space. They had a forward contract and they sold it to a hedge fund. They made 50% more profit than if they sold it to individuals to live in, right? So those things are amazing, and that's because of the price point at which Houston is at, reasonable prices, higher rents because the job market is good, and that always makes me feel good about investing there personally. Now, is it more competitive? Sure. There's a lot of big money moving in, but they are not as efficient as the mom and pops are. We can find those deals more easily. We don't have to find as many of them. We don't need to do the scale as individuals or small business owners to be successful. But it is very exciting to me whenever so many people are interested in being in this space. And we actually work with one hedge fund out of San Francisco where they will only invest in Houston. Their charter says this is the only place that we're going to buy homes because the market factors, the economics here are so strong that this is the place that they have sold their investors that it's the best spot to be in the country. So it's pretty exciting.
Plus, we're way cooler than New York and California. They just don't know it yet.
Yeah, ignore the metrics. We're just cooler people too. Cooler people to deal with, right? You're gonna have more fun down here anyway.
Exactly.
Next slide, please.
So this slide is just kind of from Redfin, and it kind of hits over the national market. I know we have folks that are from all across the country that will listen. I know we focus on Texas and Houston sometimes because we're here, but there are national investors we talk to, and we're starting to grow in that space as well. So nationally, prices were up 16% year over year in August. So same house, you bought the same house in August, it's worth 16% more this year versus last. The number of homes sold fell by roughly 2%. The number of homes for sale fell 26%. So to have such a, in my opinion, to have such a massive drop in homes for sale, yet what actually sells is only 2% down, tells me that there is a giant appetite for anything that hops in the market right now. The acceleration with which these deals get churned is through the roof, because you would think that if fewer homes are for sale, you'd have fewer sales, but that's not the case. The sales were relatively flat. There's not as many to sell, but they're just getting gobbled up like that. In 2021, home prices are up 16%. So the median price is $380. So the median sales price across the country was $380. Average 30-year mortgage on owner occupied was 2.8. That's not APR. That's just a flat rate, 2.8. But the thing that I thought was interesting was this last bullet point, and it's kind of what I was talking about earlier. This is national, but if you look at that number in 2017, which I guess would have been late 16, basically 5 years ago. If you look at this chart, the median price was 250. The price is now 380. So if you just chart that math, your property has increased 50% in 5 years. So you got a $200,000 house, now you got a $300,000 house. I mean, there aren't a lot of assets or asset investments where you can have that kind of increase over 5 years.
I mean,
it's a great market.
In Houston, I mean, I know annually, I mean, just over that's nationally, that's crazy. I didn't know it was that high, just nationwide, because I know just here in Houston, we're seeing about a 22%, as what Har said, like a 21.8% annual increase in some of the hot areas of town. Mm-hmm. And I'm like, man, that's just amazing. Like,
yeah.
Crazy. Yep. I think we'll see it in a second, but there are some hot areas. That's not the number everywhere across Houston. Obviously, there's some pockets that are less than that. Yeah. I think we're 13% on average, but yeah, if you bought in the strategic areas, they're really, really booming right now.
Yeah, we picked up some in Bel Air 59 area, and we like the Bel Air 59 area. We got a couple in the Heights, not on purpose, but we got them. But they're doing really good.
Yeah, sure. Yeah, that Heights area, Independence Heights as well, is it's always kind of been on the edge, but that area is kind of heating up.
It finally broke through, because I know I grew up in that area. I grew up in Oak Forest, Garden Oaks area before it was cool. Back when the houses were $30,000 and not $400,000. And yeah, that Independence Heights, I've been watching that for a long time, and it finally broke through, because you're right. I remember flipping houses in there for like $12,000.
Crazy, man. I tell you, it is the common premise that, if you're close to the center of town over time, it is hard for economic forces not to start to change that neighborhood, just because people want proximity to jobs and amenities, right? So it just happens over time. It's in each of those markets, like it goes to this market, it's the Heights, it gets built up, it gets changed. Garden Oaks, all these different neighborhoods. It just
East River right now.
Edo happens, and it's just a continual thing.
Yeah, that East River thing is going to change that whole side of town over there. I mean, it already was, but wait till you see what happens over the next 10 to 20 years over there.
Absolutely. That's going to be a very exciting thing. In fact, for the people that don't know, talk a little bit about that, AC.
Well, so actually I know about the area because my business partner, George, was telling me about it, because we just picked up 22 apartment units over there in that area. And what they did is they bought, what was that company? NOV? Was it NOV? Mm-hmm. NOV, I think, was an oil company. Had a big campus there right along the bayou, right in East downtown, right outside, like off of, what is that main road right there? Is that Harrisburg? I think it's Harrisburg. Yeah. So right there off Harrisburg on the bayou. And so they got all that acreage right on the waterfront of the bayou, and they're going to develop it. It's the same people that developed City Center and the Woodlands Waterway. So it's Midway. So they're backed by Wall Street money. So, they're not going to slow down in their building, and they're not raising private funds like the guy over there in Hardy Yards and stuff like that. So it's going to be moving pretty fast. But that right there is going to bring so much infrastructure and business to that whole area around there. It's going to be crazy. It's going to be crazy. They're going to have shops. They're going to have, I believe they're going to build apartments in the area. It's going to be a whole mixed use area that's going to drive a lot of tourism too.
Yeah.
I haven't been over there in a while. Have you started?
They just started doing the surveying and putting all the spots, and they're going to do a golf course on the bayou. So that I don't know if they're doing that first, but they just started doing the golf course. Yeah, they just started doing the golf course, and they have some, like right now they have some movie theaters, drive-in movie theaters you can go to over there.
Yeah, anytime you bring in that type of master planned mixed use development, the property prices around that area just go up exponentially. People want to be around things like that, and it really brings in just higher quality finishes, higher prices. Everything is a rising tide. You know what I mean? So I think it's a great area to get into right now.
Oh yeah.
Hey gentlemen, I'm popping up for just a second. Isaiah chimed in to let us know that the road is navigation. So just wanted to let everyone know.
Okay, awesome. Thank you.
Good thing.
That's good. So on this next slide, this is a very interesting slide as well. So, we talked a little bit about home prices being up 16.2% year over year. And then the home prices, I'm sorry, I'm looking at the wrong slide. My bad. I got my two screens up. My apologies. So this next slide, we're talking about the number of homes for sale. So this is a very telling thing. There were 26% more homes on the market last year, right? So we talked about this earlier, supply and demand, right? Anytime you have less supply, comparable number of people want homes, prices go up. That is just economics 101. Newly listed homes are also down. You look at the other thing that drives, is a result of a lack of inventory is the days on market. Median days on market are 16. That's nearly half of what it was last year on a nationwide basis. Months of supply, 1.3 months. That's down significantly as well, like a huge number down. And we've seen that everywhere. And actually the 1.3, there are many markets in Houston. In Texas. Traditionally, Texas was at times a little bit more days on market than maybe the national numbers, certainly some of the hotter coastal markets. But right now, you look at Austin, we're going to see in a minute, and it's been like, I don't know, half a month of supply for some time. And I think most of the major metros, I'm talking San Antonio, Austin, Dallas, are at or below this 1.3 number. So it's really telling where we're at. And then you look at this number for total supply going further back in time to 2019, and you kind of see back then, there are times there are 1.6 million total homes on the market, and now that number is hovering around 800,000, so literally half. So it's not as big of a difference from this time last year, but you go like even further back, year and a half ago, 2 years ago, nearly half as many homes on the market, and that is a huge factor on driving these prices up. Next slide.
So this is Texas data. This comes from our friends down at College Station. So a couple, they do a really good job. And if you ever want to do some research, I suggest going to their website. A couple of little things that I pulled from the recent article update. The months of inventory actually went up to 1.5. So that's the second month in a row it went up. So maybe there's a little bit of easing going on, maybe. But the fact that the months of inventory went up is a good thing. Texas's days on market fell to an all-time low of 28 days. That was interesting as well. And just so you guys know, the 1.5, a market in balance is 6 months. And we're at 1.5. So we have a long ways to go before we get back to a balanced market. But Texas's median home price posted a new record high, 16% year over year, up to 301. So the median home price in Texas is over $300,000.
Wow.
Year-to-date price growth was up 16% in July, considerably more than last year's average of 7%. So this year is a banger. And then this last little index that I like, it's repeat home sales index. So what it does is it kind of throws out new construction, and it just looks at the increase in price of existing homes, right? This is truly a good idea of, you bought a house, you sold that house, how much more is it worth if you were to sell it, right? So the state was 18% up. Houston was lagging behind, only 14% relative to the rest of its peers across the state. Dallas 23%, Fort Worth 21, San Antonio 19, and Austin's 23%. So just in that 1 year, an existing home in Austin is worth 23% more than it was last year.
Jeff, if I'm reading this correctly, this slide is telling us that the overall price growth was 15.9, but the repeat sale is 18%. So that means that the previously built homes actually went up more in price than what new homes are. The new home sale price increased year over year. Is that correct?
That's a correct interpretation. That seems counterintuitive, but maybe they're just building cheaper houses. I'm not sure.
I don't know that it's necessarily counterintuitive. From what I understand, the new homes are taking a lot longer to build because of shortages of materials, A lot of people have become frustrated with that, and has caused a greater interest in existing properties, because if you sell it, you can move in right away. There have been a lot of delays in new construction, a lot of challenges. Sometimes they were just postponing because certain things, like for a while lumber was outrageous, then it moves into other areas. There have been huge price spikes in some of these different categories. So it means that some of these existing properties that you do not have to put new materials in are very attractive, both from a speed and a price perspective. I don't know if you're seeing that as well, AC.
I was just about to comment on that and say, I think that's more what I would say, is because there's more older homes. So like we just talked about, there's not enough new homes being built for in the past years anyway. So I think we have a shortage. And then, like, you're right, now we're building 6 new construction houses right now in Setagap area, 028 of Houston, and we just got hit with another. So it took a while to get our forms permits passed or through, and now we're waiting. They just hit us with another 21 days. They just said, hey, it's going to be at least a 21-day backup right now. Everybody's backed up for 21 days in the permitting department. So we're backed up another 21 days now. So it's been like 2 months already, or a month and a half. So it's you just have more options in the older homes than you do in the new construction for that reason. They're not being built quickly enough, and there's not enough of them to go around anyway.
True, very true.
Makes sense.
All right, next slide. So this is an amazing statistic. It's been this way for some time, but single family construction permit issuance exceeded the 2006 average, which was the previous peak of new home construction, right? And that was before a time of challenge, for sure, in the housing market. I do want to emphasize, we've talked about this a lot in the webinars. Jeff and I were knee deep in the mortgage crisis back whenever it took place. There's several fundamental differences between that and now. I want to go over what, in my opinion, what those are. Number one, credit quality was incredibly low. Very low FICO scores, a tremendous amount of no income, no asset type programs, incredibly high LTVs. People were doing cash outs on their homes across the country at 125% of the property's value. An enormous amount of speculation that purely required homes to go up another 10% every year for them to be able to make those investments work, right? People were investing in properties, paying interest-only loans, borrowing 125%, and unless the properties went up that much in the next couple of years, foreclosure was inevitable, right? Because the program was going to change, the payments were going to jack up and double, and different things like that. So very different programs this time. And then also, we're not having a real estate crisis. A real estate crisis was happening then because so many people were unqualified to borrow to start. The credit qualifications right now are at an all-time high. Another thing I do want to emphasize is all of the feedback given thus far is that forbearances are going to be handled entirely differently. In that time, if someone could not make a payment for 12 months, whenever they were no longer eligible for the forbearance, they had to make 12 payments in 1 month. Now you don't have to be a mathematician to figure out, if they couldn't make any payments for 12 months, how in the hell are they going to make 12 payments in 1 month, right? It's just devised logic. Conversely, this time, everyone is saying for Fannie Freddie loans, even for more Wall Street lenders, from what we understand, the game plan is to tack those payments onto the end of the loan. I want to emphasize that is a massive difference, right? They do not have to make 12 or 18 payments at one time. They're going to tack it onto the end. So in other words, it was a 30-year mortgage. Now it's just a 31.5-year mortgage. That is a very different situation. And I think worst case scenario, if they cannot prove their ability to pay the mortgage anymore, whenever they come out of that, they're going to have a ton of equity in their home and probably be able to sell it at a premium, so it will not be a foreclosure, right? So it's hard for me to visualize a way in which there's an enormous amount of foreclosures. I think there could be some, but it's hard for me to envision an enormous amount of foreclosures. So that's one thing that we do want to talk about. So on a couple other things here, we talked about the home price index climbed 18% year over year. I'm sorry, yeah. And then down here at the bottom, I do want to cover a couple other things from this category. Home price appreciation unmatched by income improvement will continue to chip away at housing affordability. That is a true statement. We have not seen wages go up as much as home prices have gone up, right?
Yeah.
The one thing to keep in mind is that it's still exponentially below the rest of the country. We're going to show in a little bit a slide that shows what percentage of a person's income, average income in each market, has to go towards housing. And Texas is still way below these others, especially for major metros. So there's a lot of room to go up before homes become unaffordable, as they really are in a lot of these other places where people are moving out in droves, moving to places like Texas and Nashville and Florida and other things like that. This last thing is a very interesting thing that we saw an update on yesterday. So we scoured the interwebs to try and find information or updates on the status of the eviction and foreclosure moratorium. And on single family, we could not find an update. So we're of the opinion that since it has not been updated, that goes away on October 1st. That is our current opinion. We have not seen anything to contradict that. We did see very late information come out yesterday from Housing Wire saying that on multifamily, the eviction moratorium is going to continue indefinitely. So, not sure exactly what that means, but we're of the opinion that it may mean that the federal government feels as if mom and pop investors can no longer shoulder this burden any longer. 88% of people who own single family properties or mom and pop investors own just a couple of properties, right? 10 or less. And that can be a real burden for people if they can't collect it. And I think they may feel as if for the multifamily, those are large institutional investors and that maybe they can shoulder this burden a little bit longer of not being paid as much. That may be one thought. I'm unsure. This is speculation. I've not read anything that says that that's the case. That's somewhat speculation. But there are a lot of programs, and if you're not aware of those, you should really look at them. And you can initiate the process or someone else can, but there are a lot of programs out there. People cannot make their rent payments. They're Texas-based subsidized programs where the state will make the payment for the person if they are qualified. So if you are unaware of those, definitely reach out to us at Catalyst. We can provide you some information on it, but those are great programs. The one key thing to keep in mind, we made this mistake. This is not a landlord program. If you evict someone and they owe you 15 months of payments, you cannot go back and get those 15 payments thus far. This is a program for the tenants. So if you keep the tenant in, you can ensure that you get paid. But this is not something you can do after you've evicted them. Have you heard about any of those programs, AC? Have y'all been able to get in on some of that?
I haven't, and we're actually going through our first evictions with the multifamily, or we're trying to go through the whole process, trying to figure out what to do there, because I got a couple of people in some multifamilies that are being a problem. But yeah, no, I hadn't heard that until right now, but that's I mean, for the single family houses, I'm definitely excited about that. I personally, so now we just picked up a bunch of multifamilies, but we had 15 or 16 single family houses during the whole pandemic, and we didn't have anybody not pay. You know, knock on wood, you know, thank God. Like, so, and I know a few other people, friends of mine that have a lot of doors, some of them more than me. They had a pretty much the same rate of vacancies and everything that they would have in the normal time. So luckily we were right around that range. So like luckily we didn't have any, you know, luckily that was just kind of by chance, I guess. But a couple of people I know that have more than me, like I said, it was about the same for them. So as far as having people leave and fall out and not pay, you know what I mean? So, you know, I mean, I think that's going to be good, especially for the people who can't hold out on, like the mom and pops who can't make the payments and are at risk of losing everything if somebody doesn't pay them. You know, those are definitely the people who are most at risk. So
yeah. Let me clarify two things real quick. One, I do believe the people in the multifamilies would also be eligible for this program. This is not exclusive to single family. So if you want to try and get some of those people
okay.
in the program, I think you can. And then two, the other thing that I do want to say, this eviction moratorium, as I understand it, is for Fannie Freddie. I'm assuming if you got a 22 unit, you probably use some type of alternative financing, and you probably do not have an eviction moratorium there. This is for Fannie Freddie backed.
No, I don't think we have a moratorium on ours. We're just going through the process now, so I don't know what it's going to be like.
Gotcha. Yeah, I just want to make sure. Sometimes people out there don't realize that the multifamily conforming loans are larger loans. If you got a 22 unit, oftentimes you're going to use an alternative type of financing for those. So that eviction moratorium is probably not impacting you.
Yeah, we use private funds for that. But
Yep.
oh man, what was I going to say? Oh no, never mind. Now I forgot.
No worries. Next slide, please.
So I thought this was an interesting slide. It's the home sale price to list price. So in most markets, people list a house for sale and then you negotiate from there, usually down a little bit, right? That's usually how it works. And if you look at this chart from 2011, all the way until 2021, it's below 1, right? Sometimes significantly below 1, like down to 91%. So a house listed for $100,000 eventually sells for $91,000, right? If you look at it now, it's just another indicator of how competitive it is, and how if you're looking to buy houses, oftentimes people have to pay over market to get it. It's just plain and simple. The proof is in the pudding there. The ratio is over 1, which means the average deal is selling for more than what they listed it for.
If you're a home buyer right now, I mean, in my opinion, and y'all are the lenders, so you tell me this: if you're a home buyer who's approved for $220,000, I feel bad for that borrower actually, because anything in that price range is getting bid up to 250, 260. There's a neighborhood out in I live out in Tomball, and almost in Tomball, and there's a neighborhood that's not too far from mine, and it's a smaller little beginner neighborhood, like starter house neighborhood, and the sign says starting at $220,000. Well, my wife has some clients that are approved around 220,000. She showed them that neighborhood, and the sales agents over there were like, she's like, man, I'm gonna be honest with you. She's like, everything is getting bid up to 260 right now. She's like, because it's just the market right now. There's no housing, so anything in that 220-ish range, people are bidding it up.
Yeah.
And if you're approved for 220, you're kind of screwed. You're gonna, you're not gonna get any. I mean, you're gonna have to look. Even listed one for 179 the other day. It went for 220. So
there are no houses for sale at that price. Like it's impossible to find.
Mm-hmm.
And you're competing with, there's so many different target buyers in that range. You got end buyers, you have buy and hold investors,
Yep.
You have institutional investors that are looking to buy the properties at that price point because they can cash flow. And if it's a nice clean home, they can just put tenants in it right away. Like that particular price point, 250 and below, to your point, especially 220, anything, the farther you get below 250, the more desirable it is. And there's just so many different categories of people wanting to buy those homes. It's really amazing. All right, this next slide is some very interesting news. So for those of you that did not know or were not a part of our previous calls, the federal government had come in and had limited the number of loans that could be delivered to Fannie Freddie in the non-owner occupied and second home classification. It was a little bit of a challenge for a while. The pricing went up, and it was going to mean that there were going to be fewer people who could get transactions in those categories that were investors. It went from 17% down to 7%. It even went down to 3% of deliveries to Fannie Freddie could be non-owner or second homes. That was very restrictive, but we got some great news recently. All those restrictions have been removed and we're back up to 17%. We've seen great price relief. It's a great time to check out pricing. And it's very exciting because it shows a renewed commitment to supporting investors in that Fannie Freddie space. So at the end of the day, that was reversed on September 21st. So the good news for this is one thing, it can give you a level of confidence that the government is back behind this. So if you want to be a buy and hold investor, it's a very good thing. We haven't necessarily talked about this on the webinar thus far or in others, but we do have a new program where we can take your 10 Fannie Freddies per person, we can put them all into one bundle. We can redo those in a blanket loan, and then we can get you back into those better priced Fannie Freddie deals again, which with this strategy, it really keeps you in the best price at all times and really allows you to grow your portfolio. So if you haven't talked to one of our loan officers or us about that, definitely do ask about it. And now that we're back up to 17% delivery, it's going to be a big plus if you do qualify for those conventional loans.
Then that, just FYI, that is a lender-specific interpretation of those guidelines. So don't assume, if you're not working with Catalyst, shame on you. But if you're not, don't assume that they have the same interpretation of that rule. So give our LOs a call if you want to talk about doing that as a strategy.
Yes, and we have to handle both sides of the transaction because the blanket loan has to be handled in a very, very specific way in order for it to work. It's a very unique way in which we do it, and you just have to be very cautious. All right, next slide.
So, so this is just kind of, we always put this in here for perspective. This is the 30-year mortgage rate starting in the 70s to the peak in the 80s, which was over 18%. And then, as you can see, it's down to the lowest it's been, at least on this chart. The average, this was as of yesterday, the average APR is 3.33. That's owner occupied, and that's APR, so that, you know, calculates some fees in there as well. But the moral of the story is that despite all of these high prices, financing and money is dirt cheap right now. So if you're ever going to get locked in on doing some deals and getting some financing, now is the time. Because, I mean, eventually it's going to turn, right? With inflation the way it is, it's going to start going back up.
It has to.
Yeah, definitely do not wait thinking that rates are going to get lower. Rates actually went up a little bit this week.
Yeah.
And if you read anything about what's going on with the Fed, they had a couple people resign recently. Not sure exactly why. Supposedly there's some controversy on direction, but there's a lot of inflationary pressure right now, like all-time record high inflationary pressure. And the main lever that our country has in order to correct that is increasing interest rates. Not necessarily increasing mortgage interest rates, but the underlying interest rates that lead to increases. So there's no better time to hop in than right now. And we're going to speed up just a bit because we're approaching our time for questions. So I'm going to go over this slide. This first bullet point might sound like it's a bad thing to a certain extent, that July had a decline, or I'm sorry, July rebounded from July's decline. So July was down a little bit, August back up in total transactions. But this does not mean, that just means there's less inventory. It does not mean that home prices went down. Home prices continue to go up steadily, but there was just less inventory around in that particular month. Less transactions took place. Days on market year over year fell from 51 to 26. That's nearly half. Incredible number. Total property sales rose 9.2% year over year. And then a couple of interesting statistics here as well. Total dollar volume year over year up 26%. Total active listings still down, but we're just getting through that inventory more quickly, right? It's not that there's more homes out there. You got to buy that house fast if you really want it. Like, there's not time to wait. Single family months of inventory, 1.9 months, which is down 0.7 months from last year. And then, you know, another important category here, if you look at the bottom right, this is kind of an amazing statistic. We have not, I guess we didn't update this for August, but single family home rentals, there were a few less out there. But if you go from the time pre-COVID, the average rental price in Houston was $1,768, is the bottom right. July, it was $2,162. Almost a $400 increase from pre-COVID to now. So is it a good time to be a real estate investor? I think it is. And I do not see that slowing down. I think there's going to continue to be price increases in the rental market, right? Because there's less homes out there to rent. The total number of transactions dropped 10%. So less inventory and more people who are wanting to rent, which is a perfect storm for increased prices.
And even more.
Yeah, this is so I know you focus a lot on Houston AC. Anything to comment on this bad boy or no?
Well, that's all I was saying is, like, the numbers are going up because we have such great economy, everything, but and then everything that we have already standing great, but there's 1,000 people a day moving here from all over the country. So not only are we a great market, the market's going to get greater because the demand is going to get greater.
All right, next slide, please. So this is kind of what we were talking about earlier, what AC was saying about finding those lower priced homes is just impossible. If you look at the sales broken out by segment, you know, $0 to $99,000 is down a third, just because there aren't any property. You can't buy houses that cheap, right? It's almost impossible to find. And it just kind of follows the trend. 100 to 150, down a third. 150 to 250, down a quarter. So like even prices in that, homes in that price range, there's just fewer and fewer of them available. And then as prices go up, the general population of homes are shifting upwards. So that's why you have between 250 and 500,000. That increased by 31%. 500,000 to 750, almost 50% increase. And then 750 and above is still a 30% increase. So you can see there's just more and more homes settling in that 250 to 750 range. I mean, that's going to be almost, I don't have the breakdown, but I would guess that that's an overwhelming majority of homes sold in the city are in those two cohorts right there, the 250 to 750 basically. That's got to be almost everything.
Okay. San Antonio, I'm just going to hit a few highlights. If you look, the overall statistics are this. Home sales, the total number of sales is only up 2% over last year, but all the other categories as far as median price, average price, up 19 and 16%. Same story in the residential rental. Actually, the number of transactions, number of rentals that were leased, down 16%, but the average price up 7%. Not as much as Houston. Houston's up a little bit more than that, but basically the same story we're seeing in other areas. Supply down, number of transactions flat or down, but the rents and the home prices are up significantly year over year.
Great rental market.
It is really good.
So Dallas is kind of in between Houston and Houston and Austin typically. As you can tell, the median price is up 310, and this is North Texas. It's not just Dallas proper. This is a huge area that these numbers are covering. Sales closed deals were up 1%. Months of inventory is down to 1.7. So a year ago, last year, it was at 2.4. It's down to 1.7. Listings are down 22%, but I bet you anything, if you look at the closed for next month, they're still going to be right at or probably pretty flat. So I think it's look, it's the price distribution. That's pretty interesting. So what we were talking about yesterday, or just the last couple slides ago, in Dallas, if you look at basically almost half of the sales are between 200 and 400,000, right? Because you got 30% roughly between 2 to 3 and 22% between 3 to 4. So half of the market is sitting in that price range right there. It's just harder and harder to find deals below that number, if that makes sense. And we're hiring in Dallas.
Houston, Dallas, San Antonio, and Austin.
Yeah.
If you know anyone looking for work as a loan officer, we are definitely hiring. Okay, Austin. I do notice, well, it's not as hot as it was. Now, it's still absurdly hot, arguably the hottest city in the country, but the days on market, months on inventory, it's a little bit higher. It was in the single digits for quite a while. It's up to 1 month. Could be some seasonality there. I mean, it's been such a hot market, we almost ignore seasonality whenever that is a huge driver every year in, recorded history for real estate. But the months of inventory did go up a touch, still down significantly over the past. The total volume, closed sales down a little bit. You can see that. But the total sales price year over year still up 34%, right? Median sales price, that's a shocking number. Total sales volume up 18%, even with less transactions. They're just such big transactions. They're still up 18% on volume. New listings, they're starting to creep up a little bit. Active listings coming down. So maybe some people are starting to, there's a little bit more activity on new listings, but the active listings are still a bit down. Pending sales are down. But that's a market that I think is going to continue to be very hot. it's almost impossible to maintain a pace of below 1 month of inventory for any significant time. And I anticipate that number to go up a little bit over time. Affordability
Yeah,
index, get updated, Jeff, or no? Is this?
No, this is last month's. They haven't updated this month. So, so basically, you know, it's the same as before. We talked about it, and it's not a true affordability index, I guess, because there are other things. There is a stat for affordability that goes into that, but this is more. This is just based on your mortgage. All it does is it accounts for the fact what is the average income in the city, average home price, and what that equivalent mortgage payment would be. So basically, how much of your income would the mortgage payment eat up in your city is what it's measuring. So, like if you look at New York, for example, an average mortgage payment is roughly $4,500 with an average income of 63 grand. You do the math on that. Basically, your mortgage payment's eating up almost your entire income. If you look at that, that's kind of a measure between income and mortgage payments. So, you know, New York, Los Angeles, Miami, Newark, and San Francisco. Even San Francisco, if you look at their income, it's double most places. But the mortgage payment in real estate is so expensive, it's right there in the top 5 as far as most expensive, you know, payment to income. I highlighted the Texas ones just because we talk a lot about Texas. You know, like AC was saying, I think, you know, as prices go up, it'll start creeping up there as well. So we'll see, keep an eye on this and see if it starts, you know, Houston or Austin break into the top 15 or so. I think it would take a while for that to happen, but it's always a good chart to find out, you know, tertiary markets.
Equity now.
Those Texas markets down in the 60s look like great buy and hold opportunities.
And a couple other things to keep in mind. There's nothing, this is just mortgage payment, so it does not bake in taxes, right? So you're also going to have higher taxes if you have a $985,000 home, right? Secondarily, this is not baking in state income taxes in each of these states. So New York, New Jersey, California, some of the highest state income taxes in the entire country. So you have less money with which to pay your payments, and other ancillary things are also more expensive. Gas is outrageously expensive. I don't know if anybody's been to California recently, but they have the highest gas tax add-ons in the country as well. So, you know, whenever you think about someone moving to our area, it becomes enormously affordable relative to where they've been. Even though we may think it's outrageous and we're frustrated with a few things. I know I am. I'm a little frustrated when I go to the grocery store, or I'm unhappy with the gas price we have, which are still not as outrageous as other places. But those things all are going to continue to encourage people to come, which means prices are going to continue to go up. There's a lot of factors that give us confidence that Texas is a very good area in which to invest in real estate.
Hey, Wade, really quick, you made me laugh a little bit there, but you know what? You moved out of the Clear Lake area into Houston, and things are more expensive there. I noticed when I lived in the city 2 years ago, I was like, wow, why is it so much more expensive at this Kroger? Just Kroger. Awesome, guys. We did talk a little bit about our Airbnb and VRB loans. If you guys wanted to touch on this, we do have some questions and we're a little after time. Did you guys want to add anything on this slide before we move on to questions?
Yes, I'll hit it real quick. So it is unique in that you do not have to have a debt service coverage ratio. You do not have to have any documentable income. The LTVs aren't quite as high, but the pricing is very, very good, right? 4.25 on a 30-year fix. That does not mean a balloon, does not mean an arm rate. Like, that is something that you can lock in, very attractive. And so for some people, they're either retirees or they're full-time flippers and they want to get into this space, but they know that you can crush the returns on these VRBOs, but they're like, how can I afford a $500,000 house? We're not going to have the lease agreements that show adequate rent to cover it for a DSCR loan, and I also don't make enough income to cover the payment by myself. This is the program for you. And I can tell you, the highest returns we hear in real estate right now, I don't know, AC, if you're hearing anything different. We have people, single family homes that were renting them traditionally, that have converted them to VRBOs, and they went from making $500 in cash flow. We had one person in San Antonio who's doing a deal with us. She went to making $7,000 a month in cash flow because she's right next to Fiesta, Texas. It just sounds like an absurd number, but we're hearing it.
It didn't make sense to me either, but I have an Airbnb in the Heights that was a new construction, $750,000 house that we got stuck with during the pandemic. We could rent it for about $4,000 a month, maybe $4,500 a month if we put it on the rental market. We're bringing in $10,000 to $12,000 a month on Airbnb off of that property right now. So I mean, now is the slow month, so we're like it's $7,000 a month, but that's still better than $4,000 and $4,500.
Absolutely.
Yeah.
No doubt.
Awesome. All right. So thank you guys so much for hanging on a little bit after time. We are going to open the floor for questions. We have a few lined up, but if you have a question, you haven't had an opportunity to ask it yet, go ahead and put it in the question box so we can get to it. And if you guys need to hop off, we understand. You will get a recorded copy of this, so you will also receive information on the questions that we answer. If you want to get in touch with AC and his group, his information's right here. And again, they have an amazing networking event next week, or next month on the 14th at McIntyre's. It is really a fun event. I definitely recommend you guys check it out, especially if you're new and you want to just meet more people in the Houston area, or if you're coming from out of state. It's a great way to network and get involved with people that do have experience. So definitely recommend that. And without further ado, we will jump into some of these questions. Oh, wait a minute. I want to announce our winner for the contest, and I'm really excited. Thank you guys for hanging on. And while I was off screen, I put all of your names in a random generator, so it pulls one name. And Chip Pace, you are our winner. Woo! I have your email from signing up, so I will go ahead and email you the confirmation. You just received half off your hard money processing fee on your next deal with us. So we are excited to work with you. If you haven't talked to one of our loan officers yet, now you have to, because you got a great prize today. So thanks so much for joining, and we're excited to get in touch with you on that. I'm going to go up to the top, and I do have a lot of comments in here, so I apologize if I pause as I'm going through. I just want to make sure I get all the questions in order. So the first question I have here is, do you believe the arrival of these large built-to-rent neighborhoods will hurt mom and pop buy and hold investors in regards to vacancy, rental price, and ultimate home value?
That's interesting. I don't believe so.
So, I mean, I think one thing to look at is when supply and demand is a problem, which I don't know that they're building enough of those to put a dent to where all of a sudden there's so much supply that there's not enough demand. But if you look at the moment, despite a lot of permits and a lot of homes being built, existing homes those are increasing in price more rapidly than the new homes. So that's the only data point that I really have to go to. I think over time, if it becomes overbuilt, then the answer is yes. Anytime there's an overbuilding, then there's too much supply and it could create a problem. But I do not see that for a very long time. We have to make up of 10 years of underbuilding across the country in order to get back to equilibrium. I mean, it's preposterous to think that in the 50s, 60s, 70s, 80s, 90s, there are more homes built than there were built in the 2000s. But that's the hardcore reality of it. Doesn't make sense, but it's what happened. And I don't see that type of dynamic happening for a very long time.
Yeah, especially here in Houston, I think they monitor how many permits they give out, because they did overbuilding, like what, in the 80s or early 90s or something like that. I think I don't remember. One of the builders was telling me. So like it's and for us, exactly like you said, being so far behind on housing, like it's going to take a lot of housing to catch up to what we need from wherever you get it from. But you know, obviously we need more, so it has to be built.
Well, and just to add to that, a couple months ago, Jeff and I found something that showed millennials are at the age where they typically buy homes and have gotten married, and they're the largest generation. So that is definitely an impact to the shortage of houses. And then, you know, the low interest rates just had everybody, is kind of like a perfect storm for everybody to get ready for their first home purchase. And a lot of them had to turn to rental opportunities because of how competitive the market was. So I think that kind of adds and helps a little bit too. Next question. Now this one was written while you guys were speaking on a certain slide. So I'm not sure if we'll have to go back or you guys will understand because there's maybe a little bit missing that we would know if we were on that slide. So this question is, potential impact of pending legislation disallowing real estate in SD IRAs, question mark.
So self-directed IRA, real estate.
Mm-hmm.
I've not heard that they're disallowing real estate self-directed IRAs. I mean, still seems really high. If someone wants to send an article to us, we'd be happy to review that. That could be some new information, but I haven't even heard that as a potential person. Had you,
My
AC?
partner just mentioned that to me a couple of days ago, but I don't know everything about it. He did mention that it would be a major impact with self-directed IRAs and real estate if something they're trying to pass goes through or something, but I don't know enough about it. But he did mention something.
I had heard more about scrutiny on 1031 exchanges.
I heard they were going to try to disallow those too. Like that, I heard that before. No, this was just a couple days ago. They said about the self-directed IRAs.
Okay, interesting. I had not heard about self-directed IRAs. I had definitely heard about the 1031 exchanges and wanting to either eliminate that or modify the tax advantage of 1031 exchanges. So, they're meeting right now. Ways and Means Committee is meeting right now. There's supposed to be a lot of interesting information. Definitely, it seems like capital gains tax rate is going to go up. The question is how much. I've heard as little as 5%. I've heard potentially up to 39.6, which is painful. So if you are passionate about investing in real estate and would like to have a reasonable tax rate, you may want to think about your voting patterns, because it does seem somewhat imminent, and it's a pretty big change. So
No, I just used the Google real fast, and I believe what he's talking about is the 3.5 trillion infrastructure bill. If it passes, there is some stuff in there about restricting how you can use your self-directed IRA. I haven't read the details of it, but I'm guessing real estate is part of that, is my guess.
Yep. That would be unfortunate, because I definitely use a self-directed IRA as well. So we'll see. Here's the thing. At the end of the day, I don't know if anyone's ever read the book Who Moved My Cheese. There's always ways to take advantage of the different rules. We just have to see what the rules are. Hopefully they're somewhat consistent. They're not constantly changing, but smart people are going to figure out a way to play by the new set of rules. And that's just what we'll have to figure out. It may not be a 1031 exchange anymore. Maybe some different vehicle that you can use to best take advantage of real estate investing.
All right, thank you, gentlemen. This next question is, what is the best strategy for finding buy and hold properties in this market that can cash flow, since prices are up so much for the lower end single family type unit?
I still see the deals that I see come across are still very good cash flowing deals. I mean, they are harder to come by, right? But like the deals, I still see plenty of wholesale deals, and the cash out of pocket is maybe a little higher than it used to be, but not too much. But the rentals, I mean, the point, if you look at the slide from earlier, the rentals are up so much in Houston, you're still able to find really good cash flowing deals in the city.
If you do the math on that, the rents are up, let's see,
2,100 bucks right there, 2160.
So the rents are up 20%, and I think the home values are up 13%. So the math it's not that difficult to find, because the rents have outpaced the home prices.
Yeah, I was about to say, like, you could buy stuff on the market and it'll eventually catch up and be a good rental. Like, I have some clients that are, or Ceci has some clients. Like, I have investment clients that are using Ceci as a realtor, and they're looking for deals on the MLS. Of course, the best deals are always going to come from your own marketing. I mean, we do a lot of off market or marketing for off market deals, and that's where you're always going to find your best deal. We picked one up for $70,000 in Sunnyside, and we put it on the MLS. We didn't do nothing to it. Got a buyer for 110 cash. I mean, it's just that if you do your marketing, you can find the deals. But there are deals that you could purchase and use as rentals on the MLS.
You mean Med Center South, sir?
The what?
So you mean Med Center South, sir? Not Sunnyside.
Yeah,
They're south.
we had something over there, and I had prepared marketing for it, and Jeff was like, "No, we can't call it Sunnyside. We have to say it's Med Center South."
Med Center South. We're using that. New
AC,
area of town.
Take note.
Take notes. Take notes. We're using that.
I just made you another $5,000, AC.
Right? No more Sunnyside deals.
All about branding.
Great
Right?
question, Heather. I hope that helps. If you wanted to talk more about kind of what's going on in this area or in Texas as a whole, feel free to reach out to our loan officers and they can talk to you a little bit about some of that. For my next question is, does Catalyst offer programs for single family construction converting to conventional 30-year fixed? Okay, so actually this gets a little more in detailed. So Brian, I am gonna take your question and I will get you in contact with a loan officer because this is about a specific deal. If you guys want to answer the first part of that question, feel free since I asked it out loud already, and then I will provide him the rest to a loan officer.
New construction is not a focal point of ours. We have done it with some people who are going to do it with regularity, and it's something that we can discuss, but we do not do one-offs at this time. We do one-offs for everything else. Everything else, our core business is remodels and buy and hold of any type. If you did the short term with someone else and wanted us to do the long term, then that would be a great fit as well. But if you want to talk about that, we can certainly talk about it, but it would be a little bit outside of our normal consistent course of business.
Okay, thank you. And this one's kind of fun. Peter, let me preface, if they answer this is 100% going back to our disclaimer. We are not liable for what you decide to do based on the information we share with you today. But his question is kind of fun. It says, I have a $380,000 comped house in Hutto, Texas. Would you sell now or wait a bit to sell? So Hutto's just outside of Austin. They don't want to answer that question.
There's not enough data. I mean,
I really don't. Right now, I am in hold everything mode because I think we're going, like, all of Texas is going up in value, I feel, especially in Houston or in the hot areas like Austin, Houston, San Antonio, Dallas. So, I mean, I wouldn't sell anything right now. I mean, especially depending on how much I got in it. Now I might pull some cash out and use it to buy something else. But that's just I'm not really. I mean, but you should see right now, Ceci and my partner have a hard time getting me to sell anything.
So only one thing I would say, if you're at a $380,000 price point, sometimes it can be difficult to cash flow. And if you were to take that property and make $100K on it, you could buy 4 cash flowing rentals. And then you might be making a couple $100 on that $380,000 place. You might be able to make $400 or $500 a month on 4 properties. If you're going to use that money to fuel your real estate investment goals, then I can see a place in which that makes sense. But I do agree with AC. It would be to get more real estate, not to get out of real estate.
And it depends on where the house is at. Is it in a hot area? Is it in a neighborhood? Maybe you could Airbnb it and bring in a lot more cash flow. I mean, it depends. Like, there's so many, I don't know that area, but yeah, I mean, it's so much to be variables.
Yeah, a lot of data. We need a lot more data to make a decision on buying or selling or any of those things. Yeah.
As far as I remember Hutto, I haven't been out there in a few years. We used to have family live there. It's a really quaint, lovely area, good school district, small, it's outside of Austin though. Anyway, Peter, I hope that was helpful to you. If you wanted, again, to talk a little bit more one-on-one with a loan officer that will run numbers in your area and dig deeper into your specific situation, make sure to give us a call. We have our information right here. You can also email us or check out our website for more information. Marcella added, and this is just kind of funny, yes, 1031s are an endangered species. And she's been writing a lot. Scott provided us an article to check out on what we discussed a little bit ago. And then Keisha has a question. This one's probably going to be for you, Jeff. Is your funding only for the Texas market?
So long-term loans, conventional and non-conventional, we can do anywhere across the country. Hard money, our best products, and a lot of the stuff we talk about In the major metros of Houston, DFW, San Antonio, and Austin, that's where we're going to be at our fastest. If you go outside of those areas, and Atlanta, if you go outside of those areas, we can still do hard money loans. It's just going to take a little bit longer. And that's across the country. I mean, if you have a deal that needs hard money in, I don't know, Kentucky, then we can do it. It's just, you're going to need more time on the contract. It's going to take 30 to 45 days typically, depending on the market. And we've talked to a lot of folks that are in those areas, and they say, yeah, sure, that's fine. Like, especially if you're in a smaller town, Houston is the creme de la creme, in my opinion, for hard money. Like, there are, you get really good terms and speed of service in places like Houston. Smaller markets is just tougher. There's fewer appraisers. But yes, we can do hard money or non-QM or conventional anywhere across the country. It's just the varying speed depending on where you're at.
I think this has to be our last question. We're at 1:20. But I'm going to say one other thing. One thing that you can do as well, people are really trying to buy bulk transactions right now. So if you're looking to buy 30 houses or you're looking to refi 30 houses, either one, we have great products for that. Rates can get in the very low 4s on 30-year fixed, and no size is too big. So these bulk transactions, if you're affluent, you have the money to do it, can be a great way to get in the game before prices go up too much higher. So if you want to check into that, definitely reach out to us because we have excellent products to do that.
All right. Well, thank you guys so much. And again, everyone that was joining us live today, we will be sending you an email tomorrow with a link to Prosperity's website, and then also a recorded copy of the webinar from today. Make sure to follow us on social so that you're in the loop, when the hot events are coming up in the Houston area and you are ready for your next investment. Thanks, guys, so much. Have a great day.
Thanks, AC. Talk to you, buddy.
Thanks, AC.
Have a great day.
You too.